Oh, absolutely. It's actually the hot topic right now. We're talking about the HECM program. That's the home equity conversion mortgage for the uninitiated.
Exactly. And there's a company called New View Advisors that just dropped some serious suggestions on HUD and the FHA. They're basically saying, hey, we need to fix this and we need to fix it now.
So what prompted this? Was it just out of the blue?
Not really. HUD actually put out a request for information, an RFI, back in October. They wanted feedback.
Right, and I saw they actually extended the deadline for that feedback to January 5th, 2026. So New View got their homework in early with a massive blog post detailing what needs to change. Ouch, that is descriptive.
It's true, though. Their estimates show that private label reverse mortgages now make up about 40% of the market. The federal program is losing ground.
Okay, so let's get into the weeds. What is New View actually proposing?
The first big one is money, specifically the mortgage insurance premium, or MIP.
Ah, the upfront fees.
Right. Currently, it's 2% of the home's value. New View is calling this excessive and says it makes the product way too expensive.
2% doesn't sound like a lot until you do the math.
Exactly. Listen to this. If you have a home value hitting the 2026 loan limit, around $1.25 million, you are paying nearly $25,000 just in upfront insurance fees.
Whoa, that is a huge hurdle to clear just to get a loan.
Even on a $500,000 house, that's 10 grand. New View says this is a major reason why volume is so low.
But doesn't the FHA need that money to stay safe?
You'd think so, but New View argues no. The insurance fund is sitting pretty. It's supposed to have 2% reserves, but last year it was over 11%.
So they're over-collecting.
Yep. New View suggests cutting that upfront fee in half, down to 1% or less. They think the annual fees are enough to cover the risk.
Now, here is where it gets a little controversial. They aren't just asking for price cuts, they want to change the product structure, specifically the line of credit.
The line of credit is the most popular option, though, isn't it?
It is, but New View calls the current version highly unsound.
Unsound? How so?
Because the credit line grows automatically. It grows at the interest rate plus the insurance rate, regardless of home value.
I see. So you could end up with a borrowing limit that's way higher than the house is worth.
Exactly. They want to kill that growth feature. They're suggesting we make it more like a traditional HELOC, limit terms to 5 or 10 years, and stop the automatic growth.
That would be a massive change. It basically transforms the whole value proposition of the loan.
And finally, maybe their hottest take. They want to get rid of mandatory counseling.
Wait, really? Isn't counseling there to protect the seniors?
That's the idea, but New View says if we simplify the product, get rid of all these confusing options, we shouldn't need it. They think counseling has become just a check-the-box step that actually scares people away.
It's a fair point. Other complex financial products don't force you to sit with a counselor first.
Exactly. Their argument is that clarity is better than adding bells and whistles that just confuse everyone.
Well, HUD has until January to collect thoughts, but New View certainly gave them a lot to chew on.
We'll see if the government listens. Thanks for tuning in, everyone.